Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of investing in corporate bonds. Always consider the creditworthiness of the issuing company, keep an eye on interest rate trends, and be aware of the bond's liquidity. By doing so, you can manage these risks and make smarter investment moves. How to evaluate corporate bonds? Evaluating corporate bonds before investing is essential for making smart financial decisions. In this section, we'll break down key factors you should consider to assess the quality and potential of corporate bonds. Credit ratings. Credit ratings are crucial in determining the reliability of a corporate bond. Agencies like Moody's, Standard & Poor's, and Fitch provide these ratings to help investors understand the creditworthiness of the issuing company. Why are credit ratings important? Risk assessment. A higher credit rating indicates a lower risk of default. Bonds rated AAA are considered the safest, while those rated B or lower are riskier. Influence on yield. Bonds with lower credit ratings usually offer higher interest rates to attract investors. However, these higher yields come with increased risk. How do credit ratings influence your decision? Diversification. Mixing bonds with different ratings can balance your portfolio. For example, you might combine highly rated, lower-yield bonds with some higher-yield, riskier ones to balance potential income and risk. Financial metrics. Financial metrics provide a deeper insight into the company's ability to meet its debt obligations. Key metrics include debt-to-equity ratio. This ratio measures the company's financial leverage. A higher ratio indicates more debt relative to equity, which can be risky. Interest coverage ratio. This ratio shows how easily a company can pay interest on its outstanding debt. A higher ratio suggests the company is in a better position to cover interest payments. Free cash flow. Free cash flow is the cash a company generates after accounting for cash outflows to support operations and maintain capital assets. It's a good indicator of a company's ability to repay its debt. Why should you care about these metrics? Debt management. Companies with lower debt-to-equity ratios are generally safer investments. Interest payments. A higher interest coverage ratio means the company can comfortably meet its interest obligations, reducing the risk of default. Cash availability. Healthy free cash flow indicates that the company can cover its debt payments, invest in growth, and withstand economic downturns. Market conditions. Understanding market conditions can help you make informed decisions about investing in corporate bonds. Economic indicators. Pay attention to economic indicators like inflation, unemployment rates, and GDP growth. These factors can influence interest rates and corporate performance. Interest rate trends. Rising interest rates can negatively impact bond prices, while falling rates can boost them. Stay informed about the interest rate environment to time your bond purchases wisely. Industry trends. Different industries have varying levels of stability and risk. Investing in bonds from diverse industries can help spread risk. Why do market conditions matter? Economic health. A strong economy generally supports corporate growth and stability, making corporate bonds safer. Timing. Knowing when to buy or sell bonds based on interest rate trends can enhance your investment returns. Diversification. Investing in bonds across different industries can mitigate risks associated with any single sector. In conclusion, evaluating corporate bonds involves considering credit ratings, financial metrics, and market conditions. By carefully assessing these factors, you can make more informed investment decisions and build a robust portfolio. Incorporating corporate bonds into your investment strategy. Corporate bonds can be a valuable addition to your investment portfolio. They offer a balance of risk and return that can complement other assets like stocks and government bonds. In this section, we'll explore how to incorporate corporate bonds into your investment strategy. Diversification benefits. Diversification is a key principle of investing. It involves spreading your investments across various asset classes to reduce risk. Adding corporate bonds to your portfolio can provide reduced volatility. Corporate bonds typically have lower volatility than stocks, helping to stabilize your portfolio. Income generation. Bonds provide regular interest payments, offering a steady income stream. Risk mitigation. By diversifying across different types of bonds, secured, unsecured, high yield, etc., you can mitigate specific risks associated with any single type. For example, if you have a portfolio heavily weighted in stocks, adding corporate bonds can help balance the overall risk, especially during market downturns. Investment horizon. Your investment horizon is the length of time you plan to hold your investments before needing to access your funds. Corporate bonds can be tailored to fit different investment horizons. Short-term bonds. Ideal for investors with a short-term investment horizon. These bonds typically have maturities of 1-3 years. Medium-term bonds. Suitable for those with a medium-term horizon. These bonds usually mature in 3-10 years. Long-term bonds. For long-term investors, bonds with maturities beyond 10 years can be a good fit. Aligning your bond investments with your investment horizon ensures that you have access to your funds when needed without having to sell bonds at an unfavorable time. Risk tolerance. Understanding your risk tolerance is crucial in building a suitable bond portfolio. Corporate bonds come with varying levels of risk, from high-yield bonds to investment-grade bonds. High-yield bonds. These bonds offer higher returns but come with increased risk. Suitable for investors with a higher risk tolerance. Investment-grade bonds. These are safer but provide lower returns. Ideal for conservative investors seeking stable income. A balanced approach might involve mixing both high-yield and investment-grade bonds to achieve a desired risk-return profile. For instance, if you're a conservative investor, you might allocate a larger portion of your bond investments to highly rated corporate bonds. Conversely, if you have a higher risk tolerance, you might include some high-yield bonds to boost potential returns. In summary, incorporating corporate bonds into your investment strategy involves considering diversification benefits, aligning with your investment horizon, and matching your risk tolerance. By doing so, you can create a well-rounded and resilient portfolio that meets your financial goals. Investing in corporate bonds can be a smart way to enhance your financial portfolio, offering a balance of risk and return. In this video, we've covered the fundamentals of corporate bonds, their benefits, potential risks, and how to evaluate and incorporate them into your investment strategy. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.